This is level 3 of the CFA program, the topic on behavioral finance, and the reading on the behavioral biases of individuals. I'm fascinated that the Institute would begin level 3 with this reading. Let me tell you why. Let me also remind you of what we did in levels 1 and level 2. Remember, level 1 was pretty much a broad swipe at the topics inside of the body of knowledge. And then level 2, we got really deep. Remember some of those compute and calculate and demonstrate LOSs were pretty technical. Now, in level 3, what we're going to do is we're going to focus on the policy statement. So I want to compare what we've learned in the past with what we're going to learn in this slide deck. Recall that we started way back in time, 1952, with Harry Markowitz and his development of the efficient frontier, which indicated to us that there was a nonlinear relationship between risk and expected return. And then along came William Sharpe, and then Modigliani and Miller, and then Stephen Ross, and we were kind of searching for a linear relationship. I think it first showed up in that capital market line in the late 1950s, but we found this relationship that is linear, and it was based on the world that these founding researchers of finance created. Remember those assumptions? The assumptions sounded like, boy, capital markets have perfect information, investors are rational, there are no taxes, there are no bid-ask spreads or trading costs. And, we kind of had those limiting assumptions back in those original models. And then, of course, we relaxed those assumptions over the years. But the basic one here is that markets are efficient. And the efficiency of capital markets relies on what those founding fathers, did I mention Eugene Fama? He's kind of the father of the efficient markets hypothesis. They said that this rational investor was almost like a perfect investor. And I want you to think about this perfect investor as an individual who processes information completely and accurately and without any errors and without any emotions. It's a purely cognitive process. Boy, the only thing that I can think of as an analogy is Arnold Schwarzenegger in The Terminator. He was this perfect machine who came back in time to wreak havoc. But what have we found? We found that there are pockets of inefficiency. And those pockets of inefficiency then go against all the stuff that we learned in level 1 and level 2. And so somewhere around 1990, there was this body of research that grew out of economics. It grew out of psychology. And so we call this behavioral finance because of these pockets of inefficiency. And so that's what we're going to do. So I don't want you to get the sense that we're taking everything that we've learned and throwing it out the window. What we're trying to do here in this series of readings is to ask ourselves the question, okay, how does the humanity impact what we're going to be faced with when we deal with clients and we have to put together a policy statement? So look at these LOSs here. These are super simple and super short. So we're going to break these into two areas, cognitive errors and emotional biases. So what we're going to have to do is we're going to have to recognize them, and we're going to have to determine their consequences. These are great exam questions. Now, we did a little bit of this in level 1, a little bit more in level 2, but we're really going to dig deeper into this because we're now in level 3 crafting the policy statement. And so we're going to be exposed to individual clients and even institutional clients that make mistakes, that are not perfect machines like Arnold Schwarzenegger was in those Terminator movies. All right, so the reading takes a look at orthodox finance. I prefer to think of it as traditional finance of all those dudes who lived long time ago. This is what I was saying, that individuals are rational. So look at that second diamond point. They incorporate all relevant information objectively to make rational decisions. And this results in efficient markets. So remember what Eugene Fama taught us in 1970, that Markets are informationally efficient, which means that if you go to the floor of the New York Stock Exchange and you see a price for a company like McDonald's or Hershey Foods or John Deere, and that price is $100, you can be pretty confident that that price reflects all relevant and publicly available information, which implies that you're not going to get cheated if you decide to trade. Now, of course, we know that there are, what did I say earlier? Pockets of inefficiency. So the reading says, this is not true in reality. That's why we need to look at psychological factors. And so what are these psychological factors? What we're going to learn is that these are going to be mistakes up here in the brain and mistakes up here in the soul, which explains some types of stock market anomalies. And just recall what's happened in 2020 through 2022. We had COVID, then we had the recovery, then we had inflation, then we had Ukraine problems. And so what has the Dow and the S&P 500 index been doing? It goes way up and then it crashes way up and way down. So I'm going to go ahead and call your attention back to what we learned in level 1 with Modigliani and Miller, who taught us that we need to focus on the core businesses, focus on the quality of the assets when we're evaluating a company. And that's going to lead us to be able to make the correct asset selection and then maybe even asset allocation decisions for our clients. Now, look at that third diamond point there over in the blue. Individuals behave irrationally. Now, this makes perfect sense. All you have to do, for those of you who have cars and you drive wherever you are in the world, if you drive to work or you drive to a soccer game or whatever it is, you can see individuals out there driving irrationally. So if individuals make irrational decisions or behave irrationally when they're driving a car, clearly they're going to carry that behavior over to when they find themselves on the floor of the New York Stock Exchange. Now, that bottom diamond point there kind of summarizes these psychological factors. These irrational investors, they use rules of thumb, they use heuristics and shortcuts to make decisions. And so these biases are cognitive or emotional, and that's pretty much the rest of the slide deck. Now, what we need to do in crafting the policy statement as good financial analysts is to A, recognize these biases, and then educate the client on the consequences of having these biases. Hopefully then, in a perfect world, the client will say something like, oh, I made a mistake of the heart and I'm not going to ever do that again. Or the client might say, I made a mistake of the heart, but I can't get over it. So that's why we have the word adapt in parentheses. So we may have to adjust some of our asset selection or asset allocation decisions to adapt. So we're going to try to get rid of them, we're going to try to lessen them, or we're just going to try to figure our way out around them. Now, great exam questions are to identify a cognitive error. Great exam questions are to identify an emotional bias, but super great exam questions are to identify both. And so it's crucial to determine whether they are primarily cognitive or primarily emotional. So as we're going through this slide deck, remember, we're trying to wrap our hands around our head or trying to wrap our hands around our soul or our heart, or however you figure that inside of in your body here. And so sometimes those things can go back and forth, and you'll see that here. All right, cognitive biases. What did I say? These are mistakes of the brain. And there we have a beautiful picture of a blue dude with a brain up there. Faulty reasoning, so memory errors, mistakes in processing information, and a lack of basic understanding, not only of statistics, but maybe investments in general. So think about some of these mistakes, and I'll give you an example. Let's suppose a company announces that it's going to increase its dividend. So everybody rushes to the floor of the New York Stock Exchange and said, "Hey, we're going to interpret this as good news," which is a reasonable decision. However, on the way to the floor of the New York Stock Exchange, some of us take a pause, and instead of running, we walk. And we try to decide, okay, does that mean that the firm doesn't have any positive net present value projects, and it's distributing these earnings as a dividend payment. Well, maybe this is not such good news. So you have some people trying to process the information in two different ways. Now, both of these ways are reasonable. But where it becomes unreasonable is when these two groups of people meet on the floor of the stock exchange and they start reacting to each other. Maybe a herd mentality. Maybe they say, oh, those people over there are buying, then I must be wrong. I'm going to go over and join them. Mistakes in processing that information. And then, if you don't understand the Myron Gordon growth model about the relationship between dividends and growth rates and stock prices, well, then you have no business being on the floor of the New York Stock Exchange trying to add to the pricing discovery of that new information. All right, so the reading, and this is what you find when you take a look at lots of the research in these cognitive errors, is that the researchers, both professionals and professors, seem to think that these are relatively easier to correct. And so the reading does say easily mitigated through education, advice, and information. So of course, and we'll learn this throughout level 3, that part of the responsibility that we have as good financial analysts when we're crafting the policy statement is that we need to say to the client, okay, here's the policy statement, here's this section, we're doing all this stuff. What questions do you have? I bet you have questions on, let's say, capital market expectations. I bet you have questions on how your behavioral constraints impact the future value of your portfolio. And so the education process is, I'm not comfortable saying easily mitigated. I'm going to say can be easily mitigated. But remember that for the exam, that the Institute does believe cognitive bias are way easier than emotional biases are to correct. Here's the example that I give for emotional biases, and I want you to remember this for the exam, and it'll help you remember the difference between the two. Let's suppose that my grandmother, on her deathbed, she looks up at me and she says, Jimmy, here are 100 shares of Hershey Foods that I've had since I was a little girl. I want you to have these when I die. Promise me that you won't ever sell them. And so I look down at my grandmother and I say, boy, Graham, you've been so wonderful to me. I love you so much. I promise I'll never sell these shares. All right, so you're emotionally attached to your grandmother. I am. And then you transfer that emotion to the ownership of those Hershey Foods stocks. So what happens over time? Well, let's just suppose that Milton Hershey starts making bad chocolate bars and bad cereal and bad licorice, and the price plummets and plummets and plummets. What am I going to do? I'm holding on to a bad financial asset only because it's an emotional bias. So what does the reading tell us? Spontaneous impulse or intuition due to feelings and attitudes. What we're trying to do here is a combination of avoiding pain, like we're going to try to maybe avoid a loss, and we're going to seek pleasure. So way harder to correct. I mean, boy, I love my grandmother. I'm guessing many of you do too. If my grandmother thought that I should hold on to these shares, well, who am I to argue? So clearly, the Institute is correct in saying that the emotional biases are way more difficult, but I just am uncomfortable with the easily mitigated. How about just say it might be easily mitigated? All right, so what we've done for you on this slide is to give you kind of a sense of how to memorize these. I know my students and candidates for all types of professional exams like to have a memorization button there. So look at the first 3 letters of conservatism, confirmation, and control. So do con, rep hind, and then you can remember Eugene Fama for the information process. So remember, belief, perseverance, information processing. Over here under emotional biases, you can do lesser, and that gives you the beginning of each one of these. And so the Institute, as you'll see in these next slides, it covers these particular cognitive errors and emotional biases. And so now you know which ones these are. You can just memorize these because, remember now, back in level 1 and level 2, you had multiple choices. So you would pick from between and among these things. Now the questions are going to read something like, hey, identify this, and you're not going to get any help. And so if you can memorize these, that's probably a good way to do it. All right, so let's go ahead and work through each one of these. We'll start with cognitive biases. Conservatism. What this means is that when we've made a decision, whether it's an asset selection decision or an asset allocation decision, what we're doing is we're pretty confident about what we've decided. I'll just go back to my Hershey Foods example. Let's suppose we do tons and tons of research and we say, yeah, Hershey Foods, that's a great addition to our client's portfolio. But then, there's new information coming, being released not only by Hershey Foods, but by, capital markets in general. And so if that information is either positive or negative relating to Hershey Foods, probably negative is a better choice. We might be slow to update our new information. And so look at the examples. So underreacting to new information, that's a perfect one. We say something like, that new information about Milton Hershey, I'm not going to worry about that. I'm going to discount it. I'm going to underreact to it. I'm not going to attach the weight that it deserves. Here we go. Look at the third one there. Maintaining initial views and forecasts, even in the light of new information. We'll say something like, hey, I'm going to just discount that completely. That information is not too relevant. And then I love the reference to stuff we did back in quantitative methods. Remember the whole Bayesian thing. What we're kind of combining, joint probabilities, but we're adding this new information set. So what we want to do is we want to say something like, okay, the probability of Milton Hershey increasing its dividend is, let's just pick a number, say 50%. But the board is not meeting until next week. And we read in the Wall Street Journal that last year at this time, Milton Hershey had, let's say, 10 in operating cash flows, and it's just released today or yesterday that now they have 20 in those same operating cash flows, so an increase of 100% from last year. And so now what? If we ignore that new information, then we ignore all the stuff about Bayes and updating new information. So clearly, if their operating cash flows have doubled, then there's a greater probability than, what did I say earlier, 50%. There's a greater probability that the firm is going to announce a dividend increase. So I love combining what we learned in other readings and in other topics and other LOSs with this kind of stuff. All right, consequences. So this is really important. Look at the second part of that top LOS up there. The implications for us as good financial analysts in crafting and monitoring and updating the policy statement for our clients. So this makes sense. Failure to act, slow to update, and then this is probably the important one, making inappropriate financial decisions. Because, boy, if Milton Hershey doubles its operating cash flow and we expect it to have a 70% chance of increasing its dividend, boy, we need to make that decision today before that dividend announcement is made next week. Confirmation, I bet you guys know all about this, especially for those of you who read the Wall Street Journal. The great example is just simply to say, okay, when you decide that you want to get some news, most of you probably just click on your phone, but I'm still an old dude, so I look on the television. And so based on your political beliefs, you probably turn on one news channel. And if you have different political beliefs, you turn on another news channel because you want to confirm your kind of thought process. So that's probably a general example. But let's go back to Milton Hershey, and if we believe that that dividend is going to increase, so we're going to increase our allocation to Milton Hershey shares of stock, and then we see something on our phone that comes across that says, oh, Milton Hershey, something bad news, or we may just delete that, right? So failure to seek out contradictory facts or opinions. Look down at the second bullet point under example, overreacting to positive information. One of the first articles that I read when I was in graduate school that threw a little bit of a hammer into the efficient markets hypothesis was this academic journal article that was really cool that said that investors, they tend to overreact to negative information and underreact to positive information. And this led to like a dribs and drabs theory that investors, they don't like to react immediately. And what Eugene Fama and the efficient markets hypothesis tells us that we act immediately and instantaneously and fully. But overreaction or underreaction and dribs and drabs, these are kind of pockets of inefficiency that are out there. So remember, overreacting to positive information because we ignore the negative information. And I love the bolded here under consequences. So look at this. This is probably true for lots of these biases, but under diversified portfolios, because we are ignoring bad information or negative signals, so we probably keep individual securities in our portfolio that probably don't belong there. Holding too much company stock. Yeah, this is a good one, because if you work for a company and everyone comes in and says, oh, look at our product lines, we're doing great, you may want to do this. I'll give you the great example of that. You know, suppose you were an Enron employee in 1996, let's just pick a year. Well, you were making a good salary. You were getting compensation in terms of shares of stock, and your retirement portfolio was being flooded with shares of Enron stock. So when Enron crashed, you lost your salary and your job, you lost your investment portfolio, and you lost your retirement portfolio. So remember that one there. This is always a good one. Never hold too much in one individual stock, whether or not you work for that particular company. And look at the last one there, the last bullet point, setting up a screening criterion. You know, we do this, especially when we talk mostly about mutual funds. You know, at my school, we have Morningstar software on our machines in the trading lab. And so my students are on there all the time trying to, use these different screens. And I always caution them to be careful. Like, what are you doing? You're ignoring mutual funds just because they're portfolio manager doesn't hold the CFA designation. How about that one? Control, right? This is a lot of times called the illusion of control, that we think we have influence. And this goes back to the example that if we work for a company, we think that we can control what goes on the floor of the New York Stock Exchange. And of course, when we work for a company, whether we're a factory worker or a middle manager or an executive or even on the board, we have some kind of influence over the future value of the company's assets. But you can't have influence on what the entire world is thinking about the company. So while you have minor influence, you don't have enough influence there. So what this tends to do is over trading. You see this kind of, in the mutual fund manager, what they call that turnover. Inadequately diversified portfolios and concentrated investments. That makes sense. How about representativeness? This is kind of an interesting one because it has a couple of different levels to it. And I always go back to my father when something would happen. My dad would always say something like, "Oh, I knew that would happen." In fact, he prided himself on being the first one in the entire world to predict the 2008 financial crisis, because where he and my mom lived, they were building, maybe a mile or so from their house, they were building these townhouses or condominiums. And he kept saying to me, who's going to go live in those things? Who's going to buy those? So that comment and how he was saying that, he goes, "Oh, I knew that we were going to have this massive real estate crash." So think about this in two sections here: base rate neglect and sample size neglect. And so what this means is that we're probably making mistakes based on what we believed in the past, and that the likelihood that some previous event is going to reoccur. Now, of course, the main issue here for representativeness is not just that the belief that history will repeat itself, because we know this happens all the time, right? Those of you who have multiple children will know that each child makes pretty much the same mistakes that the older siblings did. But the issue here under representativeness is timing. If you can say, okay, we had a stock market crash in 1987, therefore we're going to have one in 2008. Oh my gosh, clearly we're going to have stock market crashes, but the timing is the issue. So look at the examples here. The superior skill due to a strong performance just over a short time period leads that fund manager to think, oh, well, I can repeat myself. Or if we observe, let's just say some kind of a awesome Jensen's alpha over the short term for a fund manager, then we're going to say, oh man, that individual, they did awesome. They're going to continue. They're going to continue to do that. But this is what we know. There are lots of academic studies out there that say something like, boy, when a fund manager has really good performance, it's oftentimes, and it's easily predictable that manager is going to have inferior performance over a short time. Because just like prices go up and down, manager performance goes up and down. I'm guessing that you guys know that. Look at that second orange point under the example. This might be due to luck over skill. So remember the timing issue there. That's probably the way the Institute would word that question, timing. Investing in the latest hot investment, additional costs of moving in and out funds, and lack of performance persistence. So if I were creating an exam question, I would focus on persistence, because let's go back to what Modigliani and Miller taught us in 1958 about capital structure and capital budgeting, is that the goal of the business maximize the long-term value of the company. And so this representativeness, the timing issue, then it rears its ugly head over short-termism. How about hindsight? I bet we know all this. Investors believe they can predict a winning trade. So what we're pretending is that we were perfectly informed about this event, and that event should have been easily predicted. Oh, we should have known that Tom Brady was the greatest quarterback of all time and that he was going to win. We should have known he was going to win all those Super Bowls. All right, hindsight here, overestimate their ability. So this brings in this false sense of confidence. This is really an interesting kind of a concept here. An unfair assessment of money managers or security performance. Framing. This is really a cool one. I read a study that some grocery store did when they put 2 packets of ground beef side by side out on the shelves, and one of them was clearly marked with, this has 90% fat free, whatever that means. And then on the next one over here, it said clearly marked 10% fat. So it was the same stuff. So if you read all the other things in the description, it was all the same. But the way they were presented, 90%, whatever the term was, versus 10% of fat, what did people do? Well, they picked up the 90%. And so this framing here is how something is presented. And so what we can do, and this is the way it will probably show up on the exam, is that we have 2 assets that have the exact same type of a return. So think about this. Suppose I say to you, hey, buy my share of stock over here. It sells for $100, and a year from now, I think it's going to sell for $120. Okay, and then over here, instead, I say, hey, I have a stock today that sells for 100, and it's going to I guarantee you it's going to return 20%, right? So 100 to 120, that's a different frame versus 100 and then 20%. Now you and I, we can do the math really quickly in our brains. So we know that those 2 frames are identical, but lots and lots of individuals out there are not. And the framing can get way more complex than what I just described. That's why, look under the example, we have the words in bold. The outcome looks more enticing. Now, of course, this is just what happens whenever we watch a commercial during a football game. We're trying to be enticed to go out and buy something. All right, what are consequences? I love this first one here and the last one there. Misjudge their risk tolerance. All right, so if we have a client that's framing, this is really important for us to load up on the education process. And then we don't want to deviate from the Harry Markowitz optimal portfolio that we learned back in 1952. Let me tell you a story about anchoring. Back in the year 2000, I was at a conference in Myrtle Beach, and I was presenting a paper, and I presented a paper in the morning. And after I presented the paper, I went back to my hotel room and flipped on the TV, and the Dow was at 99.92 and 99.94. So I picked up the phone and I called my mother, because my mother was a little bit of a stockholder, not much, because I have a pretty humble background. But so I said, "Mom, put the TV on." So we watched as the Dow clicked over to 10,000 for the first time. And so, boy, what did everybody say? The news, we anchored, we hit 10,000. That must mean that the economy is great, stock markets are great. So we were anchored on that. And then whenever we dropped below 10,000, we said, oh my gosh, we dropped below 10,000. But there's nothing really interesting, and there's nothing really different about, 10,100 and 9,900. They're just numbers, and there's nothing really interesting. But you see how we process this. Oh my gosh, it's some kind of a special number because it has more numbers in it. 10,000 has more numbers than 9,999. So look at the examples. Clinging to arbitrary price levels, right? So we don't really care what those prices are. We want to know how much can we buy low and sell high. So look at the consequences. They stick too closely to their original estimates. Now, let me go ahead and give you a quick homework assignment. I can no longer pick up the phone and call my mother. She's been gone for a long, long time. So those of you who still have mothers along, I want you to get out your phone and text your mother and tell her that you love her. Mental accounting. Speaking of my mother, this is what my mom used to do when we were little. We had a local retail store that had a Christmas club. And sometime when the weather changed, somewhere around, let's say early March, my mother would go down every week to this retail store, and she would hand in $5. And these were for Christmas presents for my sister and me. So every week she would go in and give $5. I don't even think my mother I don't even think she got interest on that. But then Christmas time came around. So in December, she would go and get all her money, and then she would go spend it at that retail store, and we would get a pair of socks or a handkerchief or something. Baba boom, there's a joke there. So, but anyway, this is what mental accounting is: having separate accounts. In retrospect, and what was that one? Didn't we have a hindsight earlier? I should have told my mother. Of course, I was only 10 years old. I should have told my mother, look, let's take that $5 and let's go to the floor of the New York Stock Exchange. This is in 1970, let's say, and let's go buy shares of IBM. Maybe by Christmas time, my mother would have had $5,000, and I could have had a new motorcycle or something. So let's make certain that when we have clients, and clearly this is a common and a substantial cognitive error. If clients have these mental accounts where they're separating things, and this becomes really important when a client separates their regular old investment account, in which maybe they're saving for education for their children or a retirement home, and their retirement accounts. Boy, if you separate those two and you say, okay, I have one risk tolerance for this one risk tolerance for this one, well, then there are all sorts of consequences that can arise. Look at what we've written down at the bottom. Irrationally distinguish between returns from one portfolio and another portfolio. One might be heavily geared toward income, one might be heavily geared toward capital appreciation. Let's move on to the availability bias, which is probably an obvious notion for you guys. I mean, just think about, what do I do every morning? I get up, and the very first thing I do is walk out to my mailbox and get the Wall Street Journal. And so I read the Wall Street Journal. It's right there, whatever's in the Wall Street Journal. And of course, it's available to me. It's easily gathered. And so you can just extend that simple example to, well, what do we have there? To mutual funds. You can extend that to easily accessing web pages. One of the assignments that I give my undergraduate students is to pick a company and tell me about their product lines and compute their financial ratios. And so, they just go to Yahoo Finance and they look on the balance sheet, they get the current assets, they get the current liabilities, there's the current ratio. So it's super easy and readily available. Now, there are some other pieces of information that you have to search for. And this is why I tell my students and I tell you to read the Wall Street Journal from front to back every day. Nobody really has time to do this. But some of that information that's in there might just be one sentence on paragraph 10 of an article that will be super helpful in making an asset allocation or even a selection decision. Consequences then, if you're only looking at, if here's the entire information set, and this is the information set that's readily available and easily gathered for you, well, then you're ignoring all this stuff. So it makes sense that there are consequences to this. Limit their investment opportunity set, but also look at the top bullet point there under consequences. They pick an investment based on advertising, right? So, oh my gosh, it's easily, when you're on your phone and you're scrolling through and there comes an ad, it says, oh, buy Hershey Foods shares of stock on the floor of the New York Stock Exchange. That might be the only thing that you hit, and you might say, oh, that sounds like a good idea. All right, let's switch over to emotional biases here. And so remember, we're moving from this part of our body up here to this part of our body here. So however you think about this, whether it's your soul or your heart or your core, these are emotional biases. And this first one here is in direct contrast to what we talked about back in our rational investor. Remember, rational investors are risk averse, but emotional investors are loss averse. That's a great exam question. The example that I've given many, many times before, maybe I even did this back in our level 1 discussion, is that, do you remember when Tom Brady won one of his recent Super Bowls? He was asked, oh, does this make up for the loss that you guys had to the Giants? Wasn't that the game where the dude caught the football on top of his helmet? Doesn't this win make up for that loss? And Tom Brady looked at him and said, you're crazy. He said, I don't sleep every night thinking about my Super Bowl losses and the games that I lost. And this is true of athletes and it's true of investors, that what we want to do is at all costs, we want to avoid losses. So think about this. If we bought a share of stock for 100 and it's falling, right? And it's falling down to 90 and 80. We are probably going to anchor that, right? This isn't a cognitive error, but that we're going to wait until that price gets back up to 100 before we consider selling. So that's the cognitive error. But think about the emotional side of this. That if we decide to sell at 80 or 90 or whatever number I came up with, what we're doing is we're automatically stamping a big loser tag on our forehead saying, boy, we were dumb enough to buy at 100 and now we're dumb enough to sell at 80. I'm a dumb investor. So we want to avoid signaling to everybody else that we're a loser, but more importantly, we want to avoid those losses. So what do? We hold on to those losers way longer than we ever should. And we might even sell winners too quickly, because if the price goes from 100 to 108, we might say, oh my gosh, I got that 8%. I'm a winner. I want to lock in those wins. And if you watch business channels on television or on your phone regularly, you'll hear this concept about, investors, they want to lock in their gains before they fall, or they're willing to give up future gains to be able to have a guaranteed profit today. I think some academics call that a bird in hand, whatever that means. But the reason that I gave you that example about the anchoring is because, remember in one of those earlier slides, the reading tells us that we're going to have a client that has an emotional bias and a cognitive error. So you can link loss aversion to anchoring. And what was that sentence there from before? It said something like, boy, figure out which one is the primary bias. And so clearly, because this emotional bias is more difficult to correct, we probably go with loss aversion over the anchoring if you got that in a question. And of course, it depends on the other words in the question stem that would give you more granularity to help make a decision. But that example that I just gave you is probably a good indication of what might you face on the exam. This endowment bias, look, suppose we've done tons of research and we've decided that, we want to buy shares in John Deere Tractor Company. And we even own a John Deere tractor, and we live near a farm, and our best friends are the farmers, and they have all different kinds of John Deere tractors. So we own the asset, we own the product lines, plus we own the shares of stock. And so we're feeling endowed. We're saying, you know what? The people on the New York Stock Exchange, maybe that price is 100, but they don't really know it like I do. I own it. I drive the tractor. My farmer drives the tractor, and he or she is out there. They're always smiling and waving when they're on that piece of equipment because that equipment is so awesome. And when the people on the New York Stock Exchange, when they figure this out, the price is going to rise. Yeah. Now, a lot of times this happens through inherited stock, like I was telling you about my grandmother earlier, or businesses, maybe real estate a little bit, probably inherited stock a little bit more. But look at the consequences. Boy, we'd have no idea about what are appropriate selling points for the assets that are already owned, especially if we inherited a share of stock or if we inherited a business. Potential failure to liquidate. That makes sense. Self-control. What did I say in one of those earlier examples about the dividends? We were in one group and the other group was doing something, and we did that herd mentality, and so we have no control. We say to ourselves, you know what? Let's suppose that if we see all those people over there doing something that's the opposite of what we're doing, then boy, maybe we're wrong. So we lack of confidence in our own decision making, and so what we're going to do is follow the herd, or we're just going to have some kind of decision that is not in line with the risk and return objectives of our client. So notice what we have in the bolded there. It leads to overconsumption, which probably then makes our investment in our portfolios to be substantially less. That makes sense, right? Boy, look at the bolded words down there. I love this term, hyperbolic discounting. I don't even know what that means, but it's like supersonic discounting or, super de-duper discounting there. And so, boy, what we're going to do is we're going to go ahead here. Those of you who are young enough, here's a great example. You're playing Fortnite on your PlayStation game, and all of a sudden, up pops a thing saying, hey, pay me $10 for some different skins. And you say, oh, $10, So you have these small pleasures now, but you could have taken that $10 and invested it in an IRA, and maybe you'll have $1 million by the time you retire. So think of self-control, think of PlayStation, think of overconsumption, all that stuff. Yeah, status quo. I'm guilty of this one. I can't remember the last time I changed my allocation to in my retirement balance. And of course, in 2022, the retirement balances are all crashing down. Resistance to change. The way this relates to the policy statement is not so much in our original statement and our original asset selection and allocation, but the monitoring part. And so let's link this with the monitoring learning outcome statements that we have throughout level 3. Remember, policy statement is our focus. And so, what should I have as a 61-year-old? I mean, I'm probably going to teach for another 6 or 8 years because I love teaching and, have lots of expenses. So I'm going to keep working because I love it. But, as I approach my 70th year, I probably want to switch from equities over to bonds. But I may just say, you know what, it's done me okay so far, except for the crash in 1987, the crash in 2001, the crash in 2008, the COVID crash, the inflation crash. Yeah, timing is everything here. Yeah, so the consequences, asset allocation and asset selection or selling investments. Overconfidence, this is what I was saying a little bit earlier, and this is the link between some of these biases. They're not totally independent from each other. There might be some positive correlations and high positive correlations in there. A belief in one's own superior abilities. There was an academic study done. It was a survey, and was sent out to a whole bunch of chief executive officers. And one of the questions was, rank yourself compared to your knowledge of your other CEO's skill set. Well, guess what the average self-ranking was? 95%. So on average, everybody, all these CEOs thought they were at the 95th percentile. That sounds to me like overconfidence. And then the other part of it was rank your competitors, and that was like 10% or 12% or something. So clearly you can see that emotions are getting involved in this, where we're saying, you know what, I'm better than everybody else. I'm a CEO. I'm a financial manager. I'm the manager of a mutual fund that has this much in assets, et cetera, et cetera. So what are some examples? Taking credit, right? Blaming others for failure. All right, so excessive trading, transaction costs. Here's another one of those diversification consequences, and then overestimating potential gains. What did we say just a few moments ago? We're loss averse if we're a behavioral investor. We're risk averse if we're Arnold Schwarzenegger and the rational investor. But we also have some kind of regret aversion. So this is a little bit related to what we said earlier. We want to avoid negative outcomes. Yeah, so what are we going to do? Hold on to positions too long. And here's the second one, which makes this one unique to the loss aversion, that we are going to avoid markets where there are, dramatic shifts in prices, because we don't want to have regret. Regret is that feeling that, boy, I really should have done something, and boy, what am I thinking, and what was I thinking? So we want to avoid the feelings of regret. So what might we do? We might choose overly conservative investments. We might put way too many bonds in our portfolio. And so there's no way this is going to be an efficient portfolio in the Harry Markowitz sense. All right, so what have we done? We've done lots of really, really good stuff. Remember to separate the cognitive errors and the emotional biases. Now, what I want you to do is I want you to go to this reading and look at the problems at the end of the reading. There's a handful of good multiple choice in there, but there's also some really good, just pick, these short essay questions that are so common in level 3, where you're not really given a whole lot of stuff, a whole lot of information. So, boy, I hate to say this, but memorization is going to be a key element to answering some of these essay questions. So, hey, I had fun this morning. I hope you did too. Good luck studying. Have a great day, and we'll see you next time.